Can you take us through whether or not the statements from Jay Powell today and all of the commentary we've heard over the course of the past couple of days perhaps takes a little bit of President Trump's attention and puts it on others within the Fed besides Chair Jay Powell?
Right. So Jackson Hole is a terrific opportunity to hear some of the individual voices of the voters on the Federal Open Market Committee. And that's what we're starting to hear. We shouldn't be afraid of those voices. The more perspectives that can be voiced and articulated about the huge challenges ahead, I think the better off we're all served as Americans, and a better path we're going to be on in terms of the future course of the economy. And as you know, Dominic, we have really a number of challenges ahead. Monetary policy is really dealing with a lot. Even before the last several weeks, there was the persistent question of why inflation has been below target. That's one of the things monetary policy has to struggle with. Another question, of course, has been the recent trade volatility. And that trade volatility has done a number of different things to market performance and has raised the question for the Fed and the FOMC as to how to steer monetary policy through what appears to be a continuous on-off again uncertainty with the trade tensions and the trade talks. And then, of course, we get into even bigger questions about whether, if in fact we're moving into a downturn and the indicators are coming in negative, what is the future ammunition for monetary policy? How many more tools does the FOMC have, and when do those tools get deployed? So the questions really mounting now are really quite significant. So the Jackson Hole convening is really a terrific opportunity to hear some of those voices, and for the members of the Federal Open Market Committee to lift themselves up from the day-to-day, management
Sure.
of the economy into bigger questions.
So I mean, Sarah, I have a question, and I've been asking it among many of our guests and sources that I have on Wall Street. I simply ask this: what actually causes a recession? Because we've been hearing all this talk about the yield curve, about how there's a big debate about the economic data and whether it supports the idea of an economic slowdown ahead. But it's unclear to me, and perhaps others out there, what is actually going to be that thing that drives us into a recession.
That's an excellent question, Dominic. And of course, technically speaking, we don't know if we're in a recession until after the fact, because, of course, the technical definition of a recession has to do with a subsequent look back in downturn in economic growth. So we don't know when we're in it. And sometimes it may not be a single event that kind of triggers, that catalyzes a major downturn. So it could be a movement that occurs very slowly, and you start to see accumulation of certain of the growth, the growth transmission mechanisms starting to break down or not perform as they should. Sometimes you see liquidity issues, and those issues become signals that things aren't working as they should. So sometimes it's not really a single event. Sometimes it's really a confluence of different factors. So you've been in that room before as interest rate decisions are made and deliberated. What exactly are the most important things that the Fed that you were a part of, and perhaps this Fed, are looking towards to make sure that the U.S. economy does stay intact for as long as it can? So what the Federal Open Market Committee is charged with by law is really the dual mandate. So that's really what members are focused on and need to stay focused on. They need to stay focused on two primary goals. One, maximizing employment, and two, ensuring price stability. And so those are really the pieces that they have to hold on to in order really to maintain their legitimacy
is there any
continue to have the trust.
Sarah, is there any question that those two mandates are possibly in flux right now? It seems to me both fronts are fairly stable at this point, and unemployment remains at decades lows.
Right. Well, we can say something about each of those pieces of the mandate. So on the employment side, Yes, if you look at one indicator, the unemployment rate, you would conclude essentially things must be all hunky-dory. But there are a whole host of labor indicators, and those labor indicators should all be looked at. We should be looking at, at wages, at how many people actually want to be working full-time but can only get part-time jobs. What about the number of discouraged workers, people who want to come back into the labor force but have essentially given up? So there's a whole host of labor market indicators besides the unemployment rate. And for the FOMC to do its job right when it focuses on the employment side of the mandate, it wants to look at all of those indicators, everything they possibly can, not just the unemployment rate. And then in terms of the other mandate having to do with price stability and the inflation rate, you'll remember, Dominic, that the FOMC had set, and it's kind of arbitrary, but had set a 2% inflation target and has not reached that. So from that mandate's perspective, there is still work to do.
Sure. So I also want to bring up this point, Sarah. This is probably the most politicized Fed that we've seen in years at this point. President Trump has obviously been very vocal about his criticisms with the Fed and Chair Jay Powell and with policy in general. I just want to play for you some of the comments that he's made over the course of the past few days and weeks with regard to what the economy in the U.S. is doing and how to fix it.
Jay Powell and the Federal Reserve have totally missed the call. I was right.
I'd like to see a cut in the Fed rate because that should have happened a long time ago. I think they're being very tardy in not doing it and not having done it sooner.
Interest rates are low. I think I could be helped out by the Fed, but the Fed doesn't like helping me too much. Jay Powell should be cutting rates because every country all over the world is cutting, and we want to stay sort of even.
Sarah, does the Fed want to or need to or should they help the president, or is this all about the data and the economic situation in America at this point?
It should be about the data and the economic situation in America. It should be clearly about the risks that are facing the path towards prosperity. But the FOMC and the Fed, they're going to just have to screen out this noise. It is not helpful. Sometimes it can be counterproductive, and it really is not what they need to be listening to right now. And frankly, the American people don't want them listening to it. The American people actually want them to stay independent, to be a credible force for helping us all achieve a level of prosperity.
So we focused a lot on the Fed for good reason because of the Fed Symposium in Jackson Hole, Wyoming. But you were also at one point in your life a Deputy Treasury Secretary on the fiscal side of things. What exactly could be done in America right now from a fiscal standpoint, from the Treasury side of things, to improve or prolong that economic expansion as well?
Right. So, Dominic, you're exactly right to be pointing to the other, sort of the other tool here. We have obviously monetary policy, which is an important set of tools, but fiscal policy is equally as important. And I think a lot of eyes are going to be turning now towards the role of fiscal policy, essentially because, the monetary policy toolbox is a limited one, and it has different sorts of targets and different audiences, different transmission mechanisms than fiscal policy. But fiscal policy is a very important set and potentially powerful set of tools. Now, the fiscal policy toolbox, I would say right now, probably needs, a little sharpening. The deficit right now is quite high. Some of the ammunition that could have been used in a downturn has been used in these tax cuts of the last several years. Unfortunately, the sort of sugar high from those tax cuts is waning. The Congressional Budget Office has warned Americans now that the deficit is at a very high level. This is of concern to fiscal policymakers because fiscal policymakers themselves need to know how much room they have to actually stimulate the economy, stimulate it in a meaningful way if in fact called upon to do so because of a downturn.